No.
Okay, fantastic. Thank you, Dave. Thank you, Anka. And thank you, Timing Research and Trade Out Loud, for once again inviting me to this this session here. So, all right. So, good afternoon, everybody, or good morning, depending on where you are. If you don't know who I am, again, my name is Doc Severson, and I've been around this space since 2005 in one way or another. Current services that I run are ReadySet.trade and ReadySet.crypto.com. And you might have heard of me before at Options MD or Zero Trade for a couple of years at Doc's Trading Tools, as well as the old Options Linebacker, which is still out there in some form. Okay, and my specialties are fractal price analysis, options and futures strategy, and because of the fact that I had to fix my own mindset, you become an expert at this if you trade long enough. So trading mindset is also in the hopper there. And really what I'm trying to do is not trying to create black box programs or anything like that. I like things to be relatively simple. So I'm always looking for ways to simplify the complex in trading. And believe me, there's enough complex stuff that's out there. Trading is actually a very simple thing to do. We just tend to make it complicated on ourselves just because of the way we're human beings. And because of this, I wrote a couple of books here, which you can see off to the right-hand side, Fractal Energy Trading, as well as Hacking the Holy Grail. So check those out at Amazon.com if you want to. All right, what am I going to do today? My purpose for talking to you guys here today is we're seeing thousands of new investors come on board now. And it's interesting because we had kind of a lost decade of investors after 2008 blowout. Things got really quiet for a while, and we're starting to see people jump on board again. And I think it's important that people get started in the right way, because I'm seeing a lot of awfully bad habits that are out there. People, joining the apes of Wall Street bets and things like that, which is fun, but ultimately it's a long-term, very dangerous thing to do. I want to see the small guy win without getting stepped on, or without thinking that they have to join the herd or some other wild subreddit to do so, right? So the zero-day option strategies are one of the best natural edges that I've seen available to retail traders in a long, long time, right? So my purpose today is to make you aware of them, show you a couple of examples, kind of walk you through the trade, and see if this is something that's interesting to you. Okay, that's my purpose. That's who I am. Ready, set, let's get going here. So why we're here today is really all about financial freedom. The problem is using yesterday's methods are just not going to work anymore. I hope you agree with me on that. In case you don't, I'm going to walk you through this logic here. Generally, what we're trying to do is most people are trying to grow the pile. And this is sort of what we're brought up to think, is that you have to grow the pile. So take whatever you have, and then through contributions over a really long period of time, you can grow the pile to the point where you can build up those assets and then live off the interest. And the old standard was to build up $1 million account and then live off $50,000 a year at 5% APR, which I think most people would be okay with doing if they had the freedom to do that. Problem is, we don't have 5% APR right now. As of today, we're sitting at a 10-year note of about 1.46%. Rates are still historically low. Even though we have this inflation monster going on, it may be short term. Rates are still low, and the Fed is going to maintain them at low rates for a long time. They're not producing useful yield for us. Well, we all know why this is the problem. We have the helicopter money in the Fed, and just all this massive stimulus that's out there. We're not passing judgment on there. Let's move on to today's reality. So the current alternatives is you can play the annuity game. So if we're trying to come up with alternatives to saving interest, right? There's annuities. Problem is, they're going to lock you in for years to receive a tiny little rate. We talked about bond yields. They're correlated to the interest rates, which are pretty low right now. And you can play the stock dividend game. And it can be upwards of 7%, which sounds great, but generally you're going to pay for it, because like an example like this, if you have a high yield, you generally have a poorly performing stock and, either a non-existent trend or a downtrend. So you're going to pay for it just for getting that yield. So the usual alternatives to creating income in today's market just absolutely are terrible. So this means that we have to think differently, don't we? That most of everybody else out there is just not prepared for this new reality. You can follow the old paradigm of growing your pile of assets, but being able to make money on your money is no longer there using the same old methods of interest, bonds, annuities, things like that. It just doesn't work anymore. So unless people figure this out, retirees are going to be shredding through their principal in no time at all and wondering what changed, even though this has been happening for the past 2 decades. In the words of the immortal Private Hudson, what do we do now, man? Game over, right? Is that the way that we should approach this? Well, I don't think so. There is income to the rescue. Income is what we once received through interest, dividends, and bond yields. Okay, that's what we called income, but there's different ways to get it. We can create it through passive income, which is earned without active participation. So this is interest and dividends, but in our world, which we'll show you in a minute, we can do this through something called options. There's also active income. Now, this requires participation and effort to earn that income using trading, like what Anka just walked you through, like day trading or futures trading. You have to do something to earn that income. So think about this: passive income, active income. Are there different forms of these passive and active income that can work to replace the old vehicles? Well, yes, there are. Now, a lot of people look to stocks to begin with. So just trading stocks for income, okay, maybe you can do this. I think it's difficult personally. So the market right now is way up. As of today, the S&P 500 is up 535% from the lows. Right, the Fed wants to maintain 2% inflation. What we got instead was inflation in stocks. So consequently, everything's really expensive. So even just trading the market leaders like Amazon is $33.25, Tesla $611 a share today. So these take a lot of capital, right? They require a lot of capital to trade the market leaders, even if you're trading just a couple of shares, right? How are you going to create income trading in and out of them unless you're really, really good? So day trading stocks, again, requires bigger account unless you want to play the pattern day trader rule game and dance around those landmines, right? So once you get locked down into pattern day trader, you effectively are stopped from trading again. Been there before. It's not very much fun to be in purgatory like that. So there's other ways to do this, right? And this is where I think options generally are a great answer for this. We can create passive income by selling longer term options. We can act exactly like an insurance company. So insurance company is basically writing a policy, receiving income from that, and then risk managing their obligations. We can do the exact same thing, or we can trade active income. We can look for short-term opportunities to either buy or sell options using the leverage of options to more efficiently use those that capital that we have. So to me, options are the answer for this passive and active income. So here's my assumption. Usually when we're talking about a webinar put on by TimingResearch or TradeOutLoud, this is going to be an advanced group, right? So I'm not going to go through the usual background on options and tell you what an option is and things like that. We'll get right to the strategies. So how do we generate income using 0 days to expiration options strategies? So that's what we're going to do. That's why we're here today. So the first thing I want to cover, though, is earning something on a consistent basis. If we're going to look to earn income, the first thing I want you to do is to learn how to make $100 a day. So $100 a day doesn't sound like much, right? So a lot of people, they don't listen to the rest of the presentation. They just say, oh, that guy was talking about $100 a day. How the hell am I supposed to live on that? Well, think about it this way. When I was growing up, there were, if you played fast pitch baseball, there was always a park somewhere nearby in a big city that had batting cages in them. And it wasn't just one batting cage, it was several batting cages that had these mechanized pitching machines. So you could pick the speed that you wanted to. You could pick up, so start off at 50 miles an hour, 60, 70, 80, and probably as high as about 90 miles an hour is about as fast as I remember seeing at the time. Well, a lot of traders jump right into the 90-mile-an-hour batting cage, and they wonder why they get their clock cleaned by the market. What I want you to do with this is start with that 50-mile-an-hour batting cage. I want you to start small, start slow. Small positions, start slow, understand the mechanics, and train your mind on how to think differently around risk capital. So think about this. If you can make even $10 a day consistently, and if you're out there, if you've been trading for a number of years and it's like Sisyphus, right? You roll the stone up the hill and then only to watch it roll back down again. You make some profits and then you seem to lose them all again. And you got to break that cycle. And the way that you break that cycle is to focus on consistency and train your mindset. So even if it's $10 a day, but $100 a day is a great thing to shoot for. Make your $100 and then you're out. And then you're back the next day earning that income again. So think about this. Tiny gains add up a lot. If I were to challenge you to say, hey, do you think you could get 1% better at something by tomorrow? Most people would say, well, how? Yeah, I can do that. I can get 1% better at something in my trade by tomorrow. Okay, challenge accepted. So do that and then do it the next day and then get 1% better the next day and then the next day after that. If you accumulate all those little 1%ers, the power of tiny gains means that if you get 1% better every day, you'll be 37 times better at something by the end of the year. Can you imagine being 37 times better at your trade than you are today? If you just pick one thing and you just look for tiny improvements, tiny gains will add up. And so this is why I'd say, look, if you can make $100 a day and do it consistently, it won't be long before you're making $1,000 a day. Start with something. Now, what we use is the income pyramid at ReadySet.trade. So we'll set up the strategies based on the amount of capital that they need. So something really simple like a non-directional index trade, which is like an Iron Condor or some type of time spread, we'll use more capital for those. Use a little bit more margin. We're looking for a lower return from something like that. But generally, this is passive income because we don't really have to do anything with it. Another passive income trade could be selling cash secured puts, covered calls, the wheel strategy that you've all heard of in equities, right? So these are essentially non-directional trades using a little bit more capital, depending on what we're going after, but a very simple trade, very passive income trade. And then we get into the active income trades, which are more the directional or even non-directional plays for zero DTE or futures. So these are all active income. These are all passive down here. And we use the pyramid to kind of organize our approach to this with our capital. So your approach is going to be different because everybody's looking for guidance to say, well, how much of my account should I trade? Well, it's going to be dependent upon how much capital that you have. It's going to be dependent upon how much time you have. If you don't have much time during the day, it's going to be difficult for you to approach any kind of active income type of strategy, right? If you don't have the time during the day, it's going to be difficult to do that. So you should probably focus more on the passive income strategies. And then there's knowledge. Everybody has a different level of knowledge. The more knowledge that you have, then we can drive this Venn diagram into this something to be a little bit more aggressive with the intersection of capital, time, and knowledge. So knowledge you should think as something that's always going to be variable, always going to be increasing. And then hopefully capital is also increasing. And then eventually what will happen is if you can, your time will increase as well. Your time availability as you start to become more successful because you can divorce yourself from those activities during the day that you really don't want to be doing. So everybody's approach is going to be different based on capital, time, and knowledge. So of course it's easier with larger accounts. We could just sit there and do passive income trades like sell puts on big stocks and just sit back and do nothing all month. But my assumption is that you want to work faster than that. And this is where active income comes into play. So again, what we're going to focus on today is active income using 0 DTE options, 0 days to expiration options. We're going to place these and remove them in the same day. And if we only do them 3 times a week, we can avoid small account or pattern day trader account lockdown issues. So active income with 0 DTE means that we're flat at the end of the day. Okay, good so far. I need to find, let's see where the chat window is here. I actually don't have the chat window up in case anybody's asking any questions. Probably would be better if I take questions at the end of today's session, just in the interest of time. Okay, so we talked about earning $100 a day or more than that, right? But getting some kind of consistency. So now let's get into the actual meat of the matter. Let's get into the 0 DTE options for today. 0 DTE means 0 days to expiration. These are options that expire today. Now, remember when weekly options came out, I mean, we used to have these options that were just monthlies. And on the SPX, it was AM settled monthlies. And it was a huge event when you had options expiration. Now it's kind of a non-event when it's a monthly. It's like, oh, again, because we're getting so many of these things. So even a lot of the equity stocks at this point have gone to weeklies, but as you can see, here's Friday, and then here's next Friday, and then the Friday after that. So even Microsoft is only on Fridays. So it has weekly options, and then we have some far in the future monthlies, and the weeklies are kind of in the next couple of months or so. So that was really cool when they introduced that back, 10 to 15 years ago. It was a big deal when we got weekly options, because now, we got once a week we can create income. Well, now we've tripled that because the S&P 500 has actually got 3 times as many as that. And of course, also the Russell and the NDX, but they're just not quite as liquid. We're going to stick to the S&P here. Why not stick with the big dog? So in this case, we're looking at Friday. This is tomorrow. Here's Monday, next week, Wednesday. Here is Thursday. This is an AM settled option, which stops trading on Thursday. So it can be used as a 0 DTE. However, I don't recommend it because it carries too much implied volatility, too much of an expected move into the close, and it carries that into the settlement the next morning. Okay, more information than you need. There you go. And then there's the next Friday, and then we go to Monday again. So 3 times a week, we have these things just like showing up, right? It's like rolling thunder, one after another, one after another. So the SPX has got that, as does the spiders. And oh, by the way, the Qs have that as well too. However, it's a little bit more difficult to use because it's 1/40th of the NDX. It's not a factor of 10 like the SPY and the SPX is. So you can see the spiders here has got the same set of options, just missing those monthly AM settled ones. So the SPY is a great instrument to use for this as well too. So the time decay, this is the big edge here. The time decay, think of it this way, is that you've got expiration, and this is the 4 o'clock Eastern time or 3 o'clock Central. You've got this raging fire that's sitting here on the other side of the room. Imagine that's a raging fire, okay? And you're going to hold an ice cube in your hand, and you're going to walk slowly towards this raging fire, holding this ice cube. The closer that you get to the fire, the faster the ice cube is going to melt. It's going to melt with the square of the distance. So all of this time value premium is going to evaporate by the closing bell. The closer that you get to the closing bell, the faster it goes. But the option premium of that last day is very rare, very rapid. So these are very sharp instruments. And again, I want to remind you that this is not something to learn an iron condor on. Learn an iron condor on that 50-mile-an-hour slow pitch batting cage first. Use monthly options with those, or set up your trade to expire in a month from now or 45 days or whatever you want to do. Get your mechanics down of the trade on something a little slower than learning with these. So even though they're very appealing and the thought of being done by the end of the day is really, really cool, slow down just a little bit, give yourself that cushion to make sure that you learn the strategy first on something slower. Okay, so that's what a 0 DTE option is. So how do we use these things? Well, we can trade them long. Now, when I say trading them long, what that means is you're going to buy and sell. So this is either buying a call option outright and selling it later, or you're buying a put option outright and selling it later. Call options for bullish trades, obviously, and put options for bearish trades. So we can go long calls and puts with 0 days to expiration. Under what conditions would that work well for us? Well, there's a couple. I'm not going to say that this is the greatest way to do it. This is not what I do during the day, but I want to walk you through it for those of you that can only picture things in terms of being long. Now, there is very rapid time decay, as we talked about with this. You want to get in, get your fair share, and get out. This is not a futures contract that you can hold on to and just keep raising your stop up. It's not linear. It's an option. That means that it's got a lot of moving parts to it. There's time decay constantly going in and out of this thing. There is the implied volatility is changing depending on the price movement or whatever else is happening in the market. So there's a lot of moving parts. It's almost like, you know, managing a puppet, pulling on all the strings, right? Just a lot of things going on. The idea here is that you want to get your fair share and get out. This is not a trade where you can dawdle and stay in the position because you're comfortable with it. So there's some interesting benefits to being long an option because they're very responsive. Gamma tends to spike right around at the money. So there's ways that you can design trades where they will literally explode in value as the price crosses at the money for that option. Okay, very interesting to do something like that. I mean, there's some asymmetric risk that you can design into these trades if you want to. Now, what's called a trend day is where the price opens at the opening bell at one point, and then it trends in one direction or the other. And so it's usually indicated by a somewhat large daily candle, or at least the range is there for, sometimes we have a trend day to the upside halfway through, and then it turns around and trends to the downside. So it's something where we have a lot of movement during the day. So long options are really, really good for these trend days. If you have a range day, I guarantee you will lose the trade with a long option. So this is kind of cool. This is an old school kind of market maker kind of thing, where if you want to know how much the option is going to be worth depending on the size of the move. So for instance, if the price is currently at 314 and you think it's going to move maybe 1 point, which is 10 handles on the full S&Ps, what you can do is compare it versus an option that was formerly in the money. And so something going from about 85 cents to about $1.37 or something like that would be, you know, this is what you'd see. This is the gain. So you can basically, if you're estimating a 10-point move in the S&Ps, you can set up your limit order based on what you estimate the move to be. These are difficult. You have to get so many things right. So the direction, the velocity, the identification of the trend day, the duration, they look simple in the rearview mirror. They are not. Few can do these consistently. If you're going to trade directionally on an index, you might want to consider using futures. Now, 0-day options do have some advantage with this, but overall, I think you will increase your effectiveness if you just stick with something linear like a futures contract. So if that is not so good, what about if we sold the option to begin with? Well, this is where we get the odds in our favor. So I typically don't do long 0 DTE options. I do a lot of short 0 DTE options. And one of the primary instruments that I'll use for that, or primary strategies per se, is the Iron Condor. Now, there's different types of Iron Condors, I think. There's a high probability Iron Condor. This is the one where we've got, you know, a great big wide. You're setting these things up at maybe like a 5 to 10 delta on the short option. So these are 5 to 10 delta. And quite honestly, this is where most retail traders like to begin because of the perceived safety. Now, I'm doing air quotes here in safety because there is no such thing as safety. And I'll show you a difference that you can play closer to the money and actually be just as safe with these. But people like these trades because you generally don't have to do much to them. And if the price is a range day, then it's almost a guaranteed winner. So there's a very high probability of you winning. And again, this gives that initial confidence to most retail traders. However, the reward to risk is awful. So you've got to actively manage these. Now, I'm not going to teach you how to play these because I used to do this and I don't do these anymore because I used to have a full head of hair when I was trading these things. Now, I've gone more towards the low probability and the expected move iron condors if I'm just going to do an iron condor. This is where you got a 50% probability of success, and this is a one-to-one reward to risk. So a lot of people would say, well, why would you do something like that? I'll show you in a minute, but I think it gives me a lot of advantages. There's also the one expected move iron condor. This is where we're placing the short options at about one standard deviation out of the money. This is a hybrid. This is just a different way. There's nothing better or worse about these. They're just a selection depending on what it is that you want to do. And then my personal favorite, which I'm going to focus more on for today, especially with low volatility conditions, is the iron butterfly. This is the most narrow version of an iron condor. In fact, it's an iron condor with married short strikes. They're at the same. So essentially, it's a zero width of iron condor in terms of the short strikes. So again, most beginners would say, well, that's insane. Why would you do something like that? And I have my reasons, which I'll share with you in a minute. So if nothing else, if you pick up nothing else in this presentation, you're going to think differently about how you approach option selling. So let's go into these one by one. Again, a high probability iron condor is characterized by very small, short deltas, usually somewhere between 5 to 10 delta. A lot of people like to play these by legging in. They see the price moving in kind of a range bound, choppy condition. And what they'll do is they'll use the initial rally up here to set up your call spreads, and they'll wait for the price to come back down and then set up the put spreads. And by doing so, you can create a wider version of the iron condor. Again, I'm not saying to do it that way, but some do like to do this, right? So they set it up with these things and they'll leg into one side or the other. I used to do this a long time ago. It's not that easy though. Time decay is very slow for these trades. Time decay is very slow because those options are way out of the money. You're not selling very much premium at all because they're out of the money. So as a consequence, they don't decay very quickly. You have got to stay in pretty much all day long, which I don't like to do. I like to get a little closer to the action. I like to play a little bit more close quarters battle with the price. When you go closer to the money, you get a much better reward to risk. You get much more credit to work with, and it gives you many, many more alternatives to get out quickly. So lower initial probability of success. So people will look at that and say, well, it's only got a 50% probability of success. That's terrible. That means that the broker is the only person that's going to win. And that's probably true if you hold these things into expiration. Eventually, the broker will win. But I like the reward to risk on these. I like the faster time decay, and it gives me many, many more choices to get out. Now, the expected move is more of just a hybrid, right? It's kind of in between the two. You're placing these options, and the way to identify the 1 sigma, generally something around 16 to 20 delta will get you about at an expected move. So like Thinkorswim and Tastyworks will tell you what the expected move is. You can locate your options there. You can just set them up as a 16 delta if that's available to you. Either way, it's just another form of these, right? So it's a little bit slower than a low probability condor at 50%, but still quite good. But it is faster than a high probability. And then the iron butterfly. This is my favorite version of this to use when the market conditions are quieter When we identify a range day, then you want to get right up close to the price, because this is where you're going to get in, get your fair share, and get out much faster with an iron butterfly. Smaller range to work with, that intimidates a lot of people to begin with. But again, I will actively manage this. I will set up stops with this. I'll show you some examples a little bit here. So which one's best? There's only the one that works best for you, right? Oops. Go back to this. So high probability condors are slow. They don't pay very much, so you have to scale up in contracts, but they are best for those that can't actively manage. Like if you can't actively manage the trade, if you could just put in stops on these, there you go. Will usually take all day to harvest enough premium to make it worth the trade. I'd no longer trade these anymore. This is what I did to retire myself, to quit my job. This is what I was trading. And I no longer do these. The low probability condors, the tightest range of condor per se, but faster to profit because short options are closer to the money. A good compromise, width is good, reasonably fast. I like these trades. Expect to move condors are also a good compromise. So for me, it takes about 3 hours to earn $100 for a expected move condor. So that's better than 6.5, right? So if I can actively manage risk, if I can avoid a trend day, and you can usually limit the risk to between 100 to 150 instead of the max risk of 330 with a $5 wide spread. Iron Butterfly is, again, the fastest version of the Iron Condor. It creates about $100 in about 30 to 60 minutes of hold time. Downside is the width to work with, which must be actively managed. So you can't just set it and forget it, right? Okay, anyone can enter one of these trades. The skill comes in knowing when to enter and when and how to exit. A great offense is your best defense, and vice versa. Avoiding trend days is a key. The trend day, again, is the one where it starts at a certain price and then just gets on its high horse and just takes off. We don't see those that often. Most of the time we do have range days. Okay. A lot of people talk about adjustments and adjusting trades and rolling them out and doing these things, but those add risk. Understand that always you're adding more risk to that. And don't forget that if it doesn't work out, there's 2 more days this week. You get 3 shots a week. Don't think of every trade as, oh, this is the last one I'll ever do. Now, let me cover something else, which could come into play this summer if we get really low volatility conditions again. If we break higher from here, if we have a teenager VIX, which we're working on right now, we may be going into calendar spreads. These are faster than iron condors, but they have their own pre-trade requirements to ensure success. I will say this, if you're going to trade a calendar spread, if you learn how to trade a calendar spread or any other type of time spread, this will make you a better trader because you have to think in more than one dimension. You do have to do that with iron condors and butterflies, but not to the same degree that a time spread. So a calendar spread, which is what I'm going to talk about here. I'm not going to talk about diagonals or anything else. I'm just going to talk about calendar spreads, which are at the same strike. Selling today's 0 DTE option and buying a back option at the same strike 1 week later. That's a calendar spread. The reason why these work, the edge here, is, again, remember that initial option that we're selling, which is right there. That's today. We'll call that T1. That's the front option. The back option is the one back here. This is the back option. This is not going to lose that much time value in that day that you're trading the 0 DTE. So this is the back option back here. So the differential between the two is what we're selling. This is how we create profits with that. So understand that this is a fundamental edge. This will never disappear. You will always have today's option expire to nothing, and always next week's option will carry some type of value to it. Okay. Now it's not quite that simple though, because they do move around quite a bit. The risks here, in my mind, There's probably more than this, but the basic risks here that we have to be careful of are trend days, just like with the Iron Butterfly or Iron Condor, and shrinkage. Think about this. What would have to happen for the back volatility, the back option volatility to collapse? If you have the back option collapse in value, usually due to implied volatility dropping out, this is where the trade will have a difficult time. An example of something like this would be is if you trade this over FOMC and the back option's carrying a lot of volatility to it. And then as soon as Jerome Powell does a statement, everybody goes, oh, okay. All right. Certainty's coming back in the market. Everybody can quit holding their breath and the options kind of collapse in value. We see this all the time. So be careful about how you trade these. So we can adjust these for trends. This is not what I recommend doing. I don't like doing this, but you can double a calendar. You can actually give yourself more room by actually appending another calendar onto here and turning it into a double. I prefer to stay with a single if and when possible, because again, singles allow me the very fastest form of getting in, getting my fair share, and getting out. Double calendar, even though it looks great because it's nice and fat and wide, is very, very slow compared to a single calendar. So if I have to adjust this by adding, I'm doubling my capital for this, and I'm generally adding another degree of time that I have to hold on to the trade. So for a double calendar, whereas I could have probably gotten out within 30 minutes, more than likely I'm going to have to stay in there all day long if I double this on a 0 DTE. The one thing that you have to understand is if you're going to do something like this, if you're going to adjust trades and double a calendar or do adjustments, something like this, it turns out to be an accounting nightmare. And so you do want some type of tool that can tell you what to do, when to make the adjustment, and when to get out, right? You start adding all these positions up and all of a sudden, unless you got your calculator in front of you, and unless you do it accurately, are you sure that you just made a profit on that trade? This is where it helps to have some type of spreadsheet or some type of worksheet that can basically automate the decisions for you. Now, which is better, condors or calendars? Well, it kind of depends on what type of market that we're in. Iron condors are easier generally to trade in and out. They can create more distance so we can make them wider if we want to than a calendar spread, because a calendar spread's going to be more similar to like an Iron Butterfly in terms of just the shape, whatever. But if we're talking about low volatility conditions, then we're almost comparing an Iron Butterfly and a calendar together. So Iron Condors, or in this case, Iron Butterflies, are easier to qualify. They're easier to trade, a little bit more distance maybe, but they can be really tight when the implied volatility drops and your expected move per day starts to drop under 20 points. Yesterday was 14 handles of expected move, plus and minus, starting to get tight. So calendars are coming into play here. Much more rigid qualifications, more variables to be qualified. This will make you a better trader because there's more things to understand, but they are faster. And also, just a little aside here, you can actually do a 1 day to expiration trade on a calendar, and it's a viable trade because there is enough decay that occurs fast enough in those trades. Not something I do all the time, but it's a viable trade. Okay, so that's calendar spreads. That's all I'm going to talk about on calendar spreads. So what about charting? So we've talked about what the strategy is. We've talked about which one to use when, things like that. What kind of technical tools to use for something like this? So what technical charting tools do we need? Now, what type of studies do we use? None. Not on your life would I put a lagging study on here, like a MACD or stochastic or RSI or something like that. Don't do it to yourself. Don't put that type of, you will not be able to make a decision on these if you put lagging studies on here. Learn how to use price to frame in the intraday battlefield. So price gaps are one of the things that we can use. If the price gaps, and of course a gap is when the S&P futures are out there trading on the Pacific market and the European market, and they dramatically move overnight. That's going to cause a price gap versus what the cash market's doing. So as it gaps, follow those gaps and see whether or not, like here's an example of just the price opens here, closes there. That's a gap and go. That thing just took off. Did not even look behind it. Here's an example of a gap that happened where it got filled. A gap that got filled, where it gapped up and then came back down, filled the gap, and then came back up again. So a gap and go, you're probably going to see a trend day. If it's a gap and crap, right? If it fills the gap, then very likely you're going to see a range bound day. And that could be a good candidate for one of these strategies. So price gaps is a tool that we use. Probably the main tool that I use is the opening range. This is actually yesterday's price action. We set up the opening range. It was about 8 handles, and then the price just stayed within the range. And so as long as it stays within there, it's a range bound day. And if it typically stays within there, now what you'll see is so here's another example for this, is that here's a trend day. We set up the opening range, and then as soon as the opening range gets set up, it's off and running again. That's a trend day. You want to avoid these trend days. So just simple tools like this, like the opening range, is all you really need to be able to trade this. The expected move is also something that we will use every single day. We will map out the expected move. And what we're doing is we're applying the SPX expected move onto the futures. We're just overlaying the SPX expected move here, plus and minus, and setting up these, because what we'll find is that the price does react. More often than not, the price will react to that. And sometimes what I'll see is the price will get trapped in between the lower or upper expected or opening range and the expected move. We're just trying to catch the price in a range. Yes? Does that make sense? And we're using a range-bound trade to take advantage of this on a short-term basis. So these are really the only tools that you need. You don't need any special studies to be able to trade this. So I would say keep it simple, guys. You can't predict the future. Do the best job that you can to avoid being trucked by a trend day. Or if you see a trend day setting up, trade it with futures or go long the options. The problem here is that you can't win from the sidelines. You'll definitely lose if you wait for everything to feel good. This is what most retail traders do. They wait for everything to line up perfectly, and then by then the trade's over. Keep it simple. Remember that these trades show up 3 times a week. Get back up and get in the fight if you get knocked down. This is how you learn. So that's charting in TNA. Okay, so let's look at some examples here. So all of these are on the SPX, but they could have been used on the SPY. So calendar spread, here's one that we did a while back. We really haven't had the right conditions for this since last summer. And you can see that the hold time of this is just ridiculous. This is 7 minutes of hold time for this trade to get $125 profit on one contract. You can see how wide the range is here. So we were selling a lot of front volatility here. The back volatility stayed steady or rose. And it was 7 minutes of hold time on this dude. I mean, you can't get better than this. This is why I love time spreads, but they got to be the right conditions to do them. Here's an expected move iron condor. And again, I'll use an expected move iron condor a little bit wider if I just don't know what's going on. If I don't know if it's going to be a trend day, if it looks like we have a potential range, but something could happen later on in the day, I'll give myself a little bit more room. Generally, I don't use these, but I will if I'm a little bit more concerned with potential event risk coming into the day. So this one, you can see that it took us for $50 of profit on the SPX per contract, took 78 minutes. 78 minutes the whole time, which is not that bad for a 15% return on risk and plenty of room for this thing to run around. In this case, the room or the width in this went from 3090 up to 3165. So that's a 75-point wide Iron Condor. Not bad for 78 minutes of your time. Here's a low probability Condor. Again, I'll use these if I'm just a little bit more concerned about event risk. And we placed this one back in November when things were a little squirrely. 107 minutes to make 50 bucks, 20% return on risk. And what I love about these is the risk. These are literally trades where you can walk away from. And I will place these if I'm traveling or if I'm driving across town or if I'm saying, look, I just can't manage an Iron Butterfly right now. I need to go to Lowe's and grab something before, before my day starts, something like that, right? If you just want to set up a trade where you just don't care, risking what you reward is not a bad way to go on something like this. Now, typically I won't do that. I won't just take a full loss on these if I can help it, but this is a great trade for set and forget, or if you can't be there for every second of it. Now let's get to the Iron Butterfly. This is the one that I'm most interested in this market. Here's an example of a 12-minute Iron Butterfly. Nice wide Iron Butterfly, nice big fat credit. 12 minutes of hold time gives you 36% return on risk. This is quick. There's no doubt this is quick. Typically, these are not this fast. But the risk on this trade wasn't that bad based on where we set up our stops. You can see my stops here are set on the price slices. These are determined from the expected move set for the day. Here's another example, which is we entered around this area. This one was just a week ago, I think. So we entered right there. It looked like the day was going to be a range-bound day stuck in the opening range. And then it started to trade above the opening range. And I got to the level where I said, this thing looks like it's about to run from here. It looks like it's consolidating and getting ready to break out. So I've earned my fair share. I'm going to get out of this trade. It was a 51-minute hold to make 17.17 R, 60 bucks a contract. Okay, modest gains. Here was yesterday's trade. Again, here's that opening range that we had. We had very flat range-bound price action. Perfect for an Iron Butterfly, even though it was a somewhat narrow Iron Butterfly with a low credit. 860 credit, 760 exit. Took about an hour for this trade to matriculate. You can see the lower and upper stops here and how much range we had to work with. So don't let the narrow range of a butterfly intimidate you because, again, time is a risk. And if you can put time in your favor, these work out very, very nicely. Okay, so those are my examples. Let's recap here. Let's put it all together. What should you do from this point forward? There's only, in my mind, one narrow path to success. Make your shift to an income focus. Get away from those old instruments that just don't work anymore. Learn options, apply zero-day strategies, learn to make active income, stay small. So don't forget, growing your pile, don't focus on growing capital that you can't create passive income from using traditional methods. Focus on creating income today using passive and active income. Use options. They offer limited risk, high probability trading strategies requiring far less capital and better risk control than stocks do. The cost is knowledge. Its cost is always going to be knowledge with options. $100 a day. Don't try to climb the mountain of financial independence all at once. A lot of people out there advertising, hey, we made 5,000 today. We made 10,000 today. Encouraging retail traders to overtrade and blow their accounts out. Not like that. I think start small and train yourself how to start slow. And what I want you to do is start slow and consistently, and then put the hammer down once you get the skills. Learn zero-day options. Zero DTE options have a 6.5-hour lifespan, display very specific characteristics for time decay and gamma that can be used as an edge for short and long option trades. Learn about iron condors. Find a style of iron condor that's going to work for you with entry, defense, and exit techniques. Or learn calendar spreads as well and use them in the right conditions that give you the edge. Trade small to begin with. The SPY offers 3 times a week opportunities at 1/10 the capital required as the SPX. No matter how large your account, I don't care if you have a 6-figure account, you should start with the spiders. Just start with one handle, or I'm sorry, one contract of the spiders until you get good at it. Having more money doesn't necessarily make you any better at a strategy. And never forget, repetition is the mother of skill. Okay, so that's what I want you guys to do. And today I am not going to sell anything to you. I'm just going to encourage you, if you like what you hear, and if you want to stay connected to us, this is how you can do it. Sign up for free at elite.readyset.trade. You can just join out there today. That's the website. There's no .com in there. It's a .trade extension on the URL, elite.readyset.trade. Let me type this in. Oh, David did it. Thank you, David. And you can join what's called our 10X tribe. So I post out there all the time. You can see what's really cool about it is we have trade setups. So I have scanners running, which just dump trades right into the room. You don't have to pay anything for that. You can just be part of our 10X tribe, be part of our discussion. We've got 1,400 people out there today, right now, talking and helping each other. And that's for free. There's no obligation. You can stay as free as you want to. I mean, you might see something in there that you might want to pay for. You know, if you want to learn more about the zero TTE, we have ways so you can get into that class as well too. But I'm not going to pound on you guys today. You can make that decision later on if it's something that interests you. So again, for the last time, join our free 10X tribe. Just go to elite.readyset.trade. Or if you have any questions about today's presentation, if you want to reach out to me personally, you can reach me today at doc@readyset.trade. And David, I have come in right on time, and that is the end of my presentation. So thank you, everybody, for hanging out and listening to the presentation. And I'm going to yield it back to Mr. Cosmitter. Thank you, David and Anka.